In the last video, I showed you what a structured note looks like from the outside, the coupon, the barrier, the protection. Today, I want to show you what is happening on the inside, and this is the part that is rarely explained properly, how the banks actually make money from these products. Because here is the thing, if you understand how the bank operates, what they are doing, where their profit sits, you become a completely different kind of investor. You stop just accepting what is put in front of you and you start being the person who reads the term sheet and knows exactly what is fair and what is not. That is what this video is about. So let us start with something very simple. Why do banks create structured notes in the first place? Most people assume banks create these products as a favor to clients, like they are doing you a service. But this is not how it works. Banks are not designing these products as a favor. They are designing them as a part of a very deliberate business model. And structured notes serve the bank's interest just as much as they serve yours. From 2011-2014, I worked at a private Swiss bank in Geneva, and I saw this from the inside. Structured notes were not just a product we offered to clients, they were central to how the bank operated. So let me explain what the bank gets out of this. When you invest in a structured note, you are effectively lending money to the bank. Think of it as a bond with conditions attached. You provide capital, the bank gives you a detailed payoff in return. Every bank needs capital. They need it to fund their lending, their trading, their operations, and they can raise that capital in different ways. They can borrow from other banks, they can issue bonds in the open market, or they can issue structured notes. When a bank borrows from the open market, say through a 5-year bond, they might pay 4% interest. That is their cost of borrowing. But when they issue a structured note, the effective cost to the bank is often lower, because unlike a regular bond, where the bank commits to paying you a fixed return no matter what, a structured note gives the bank more flexibility in what they owe you. And that flexibility has a cost advantage for them. In other words, the bank raises capital from you at a potentially cheaper rate than they could get elsewhere. That is the first reason banks love structured notes. The second reason is the risk transfer. Banks have exposures to interest rates, to equity markets, to currencies. Structured notes allow them to transfer some of that risk to investors. This is not the bank offloading something they do not want. It is the bank matching what they need with what investors are looking for. And the third reason, fees. Banks embed their margin into the product. It is built into the pricing. You do not see a separate line item that says bank profit, but it is there. Now, once you understand why the bank creates these products, something naturally comes to mind. Does the bank actually need me to lose money for this to work? A lot of people assume the answer is yes, that the barriers are there to catch you out, that they set these conditions hoping you will breach them, so they can profit at your expense. That is not really what is happening. The bank is not placing a simple bet against you. Once the note is issued, they typically hedge much of that exposure through the market. So the barrier is not a trap. It is simply one of the terms that defines the risk you are taking and the return you are being offered for taking it. The bank does not need you to lose. Their role is to structure, hedge, and price the risk from the outset. And they earn their margins for doing exactly that. I'm not telling you this to scare you. I am telling you so you understand how the other side of the table operates. Because the moment you understand that, you start making much better decisions on your side. Now, once you understand why banks create these products, the next question is what actually sits inside them. If you rip apart a structured note, and I mean really take it apart, you will find two components, just two. One is a bond, the other is a derivative. Let me explain. The bond is the stabilizing part. That is what is designed to bring your principal back at maturity. When you invest $100,000 into a structure note, a large portion of that money is allocated to a zero coupon bond structure. In simple terms, a bond that does not pay you interest along the way but is designed to return a fixed amount at maturity. So for argument's sake, you put in $100,000. A large portion, say $88,000, is allocated to that bond structure. That is how the principal protection is structured into the product. The remaining $12,000 goes into derivatives, options. These are contracts that give you exposure to market performance, the S&P 500, a basket of stocks, whatever the note is linked to. This is the part that creates your market-linked return, your coupons, your participation, your payoff. In a typical capital protected note, roughly 80 to 90% of the money goes into the bond structure. The rest goes into derivatives. The exact split depends on interest rate, on the term, on the structure. But that is the general idea. That is how the product is built. Now, here is the part that surprises most people. Your entire investment is not directly invested into the stock market. Most people assume that. They think if I buy a structure note linked to the S&P 500, all my money is riding on the S&P 500. It is not. The vast majority of your money is in a bond structure. Only a small slice is used to create the market-linked return. That is why structure notes can offer protection. The bond does the heavy lifting, the derivative is what creates the return. And once you see it this way, the term sheet stops being intimidating because you know exactly what you are looking at. Now that you know what sits inside a structure note, the next thing to understand is how does the bank decide what to offer you? Because this is where pricing happens, and this is where things gets unclear for most people. When a bank sits down to design a structure note, there are three numbers that determine everything. The first number is their cost of funding. This is how much it costs the bank to borrow money for the term of the note, say 3 years or 5 years. Every bank has a different funding cost. A bank like JP Morgan or UBS will have a very strong credit rating, which usually means their bonds are more expensive to buy. So more of your money goes into securing the capital and less is left for the derivative. A smaller bank with a higher funding cost works the other way. Their bond is cheaper, which leaves more room to generate a higher coupon for you. This is why the issuing bank matters. It is not just about safety, it directly affects what return you can be offered. The second number is the cost of the derivative. The bank goes to its trading desk or to the open market and prices the options that will generate your return. This depends on volatility, on interest rates, on how long the note lasts and what the note is linked to. For example, an option on the S&P 500 is typically cheaper than an option on a single volatile stock. So a note linked to the S&P 500 may allow for stronger protection terms because the underlying risk is lower. The third number, and this is the one almost nobody talks about, is the bank's margin, their profit, the difference between what the note costs to build and what they charge you for it. The bank's margin is embedded in the pricing. It is not shown to you as a fee. It is baked in and it varies by issuer, by structure, by market conditions. So when your banker says this note pays 8% with a 35% barrier, what they are really saying is after the product has been priced and the bank has taken its margin, this is what is available to you, and this is nothing unusual about that. Every financial product is priced this way. The question is not whether the bank profits, the question is whether what you are getting is fair value for what you are giving up. And this is a question you can only answer if you understand how the pricing works. Without that, you are simply accepting what is put in front of you. So let me show you exactly what this looks like in practice. For argument's sake, a bank offers you a 3-year note, 8% annual coupon linked to S&P 500. 35% barrier, here is roughly what is happening behind the scene. You invest $100,000, the bank allocates roughly $88,000 into a zero coupon bond structure, which is designed to grow back to $100,000 over 3 years. This is how the principal protection is structured into the product. The remaining $12,000 goes into options, derivatives that are structured to generate that 8% coupon each year, as long as the S&P 500 does not breach the defined barrier. Now, the cost to the bank of those options might be $11,000. The bond structure cost $88,000. Total cost to the bank $99,000. The remaining $1,000, that is the bank's margin, their profit. On a $100,000 note, that is 1%. Now, is 1% fair? That is the right question to ask. And the honest answer is, it depends. If the note genuinely delivers 8% annual income with well-structured protection, that 1% is a reasonable cost for that engineering. But if the bank is charging 5% margin and giving you a mediocre op coupon, then the value proposition starts to look very different. And that is exactly why I say the difference between a great structured note and an expensive one is not the product, it is the pricing. The product is the same, the structure is the same, the only difference is how much the bank takes and how much you actually receive. Now, if you're taking one thing away from everything we have covered today, banks are not charities and they are not villains. They are counterparties. They operate from their side of the transaction. They have their interest. You have yours. And a good structured note is one where both sides benefit. Your job as an informed investor is not to avoid structured notes because banks profit from them. Every financial product is priced with a margin built in. Mutual funds, ETFs, insurance, everything. Your job is to understand enough about the pricing to recognize what you are actually being offered, to tell the difference between a fair deal and an expensive one, between a note that is built for you and one that is built for the bank. Once you understand the pricing, you stop asking, is this good? And you start asking, is this fair? That is exactly what we are building in this series. So let me leave you with this. When you invest in a structured note, most of your money goes into a bond structure. A smaller portion goes into derivatives and the bank earns a margin through the pricing. The only thing that varies is the pricing. And now you understand where to look. That changes how you read a term sheet entirely. In the next video, I'm going to show you how to read a structured note term sheet line by line. What every number means, what to watch out for, and how to spot when something does not add up. If you have questions, feel free to reach out, and if you found this useful, I'll see you in the next one.